In this slide we cover a stage 2 advice which is on pensions and inheritance tax. So firstly, once again, I'll cover that pensions are advised by our regulated partners and is not part of Blue Bond's remit. However, we can explain the generic side of it and how it impacts upon inheritance tax and why you need to consider a referral to our regulated partners if you fall into these scenarios and you have a sizable pension pot. So all approved pensions are held subject to trusts already. So if people have pensions and they're approved, which the vast majority are, then they're held subject to a trust, and that has implications obviously on inheritance tax. So firstly, there is no inheritance tax or capital gains tax if people die before age 75 in the UK on a normal approved pension. There's no income tax on the beneficiaries if those same people die before age 75. This obviously makes it very, very tax effective before age 75. There's no CGT or inheritance tax if people die withholding those pensions after age 75. So once again, very tax effective. There is income tax, however, on the beneficiaries if people die after age 75, and the implications of that will be explained by our regulated partners. So therefore, in summary, pension plans are highly tax efficient plans for the majority, and if people are holding sizable pension plans, they need to consider these plans as part of their overall inheritance tax and what they need to do with it and how best to deal with it. So effectively, the main point of this is to explain that people who own sizable pension plans should seek independent financial advice, and if, as part of dealing with you as Blue Bond, we note that you have got a significant pension plan, we will be referring you to our regulated partners under your agreement. So really, yeah, pensions highly tax effective and should form part of the overall advice to deal not only with your inheritance tax but your other taxation.